Welcome to This Explainer. Today, we're talking about a massive, frankly mind-blowing shift in global finance. For years, everybody just assumed developing nations would, slowly play catch-up with the technological footprints of the West. But that's absolutely not what's happening. Instead, we're seeing this massive, accelerated leap. We're going to unpack exactly how countries across Africa, South America, and Asia are totally rewriting the rules of money, literally turning basic cell phones into banks and making physical cash a thing of the past. So, let's start with a question that might actually sound a little crazy at first. Why on earth is transferring money in the US actually slower than it is in Kenya or India? I mean, if you live in the US, you absolutely know the pain here. You try to transfer funds between banks, and it takes days, especially over a weekend, or you get hit with this hefty wire fee. But meanwhile, a street vendor in Nairobi or a farmer in rural India, they can settle a transaction instantly, for free, with just a few taps on a cheap smartphone. So, how exactly did this happen? Well, to understand that, you really have to look at the massive contrast between the systems. In the US, the banking infrastructure relies heavily on these ancient legacy rails. We're talking about the ACH system, the automated clearinghouse, which was built literally decades ago. It's heavily siloed and it takes 1 to 3 business days to clear. But then flip that and look at India's Unified Payments Interface, or UPI. It's 24/7, it settles instantly, and it is completely interoperable. You see, in the West, the old financial institutions make billions off transaction fees, so their entrenched mindset is kind of, hey, if it ain't broke, don't fix it. But in India, the government aggressively pushed for a totally frictionless, free system to jumpstart the entire economy. And this brings us to a really crucial concept: leapfrogging. These developing nations aren't just catching up, they are completely bypassing the heavy, outdated institutional structures that hold Western economies back. Think of it like this. Leapfrogging is what happens when you don't even bother tearing down miles of old copper telephone wire because you just skip straight to building cell towers. In finance, because these countries didn't already have deep universal legacy systems like credit card terminals everywhere or entrenched clearinghouses, they essentially had a blank slate. They were perfectly free to build directly on top of the technology everyone already had in their pockets, the mobile phone. Let's actually look at how this whole thing played out chronologically because it's pretty wild to see it built. Back in 2007, Kenya introduced M-Pesa. This was literally the spark that lit the global fire. Fast forward almost a decade to 2016, and India takes this concept and scales it to an unbelievable level with UPI, shifting away from a private system to a massive public protocol. And then, jump to 2020, Brazil launches Pix. They basically took all the lessons learned from the previous decade and engineered what is, without a doubt, the most advanced public payment infrastructure in the world today. Okay, let's rewind a bit to that very first spark. Back in 2007, Safaricom and Vodafone pioneered M-Pesa in Kenya. And their genius move? They brilliantly turned regular mobile phone airtime into a proxy currency, essentially building a vast network of branchless banking. It actually started as a way to just lower the cost of microcredit, but customers quickly adapted it to text remittances home to their families. In a country where formal bank branches and ATMs were super scarce, the local corner store selling phone minutes suddenly transformed into the local bank teller. You could hand over cash, get digital credit, text it across the country, and the receiver cashes it out at their local agent. Honestly, it changed everything. Now, when we break down the actual technological DNA of these platforms, there's a really clear progression. M-Pesa is what we call mobile money. It's run by a private mobile network operator. Super effective, but relatively closed off. Then you have UPI in India, which is a true hybrid model. The government built the underlying infrastructure, but private companies like Google Pay and PhonePe build the consumer-facing apps using commercial bank money. And finally, Pix in Brazil. Pix is pure central bank public infrastructure. The Brazilian central bank stepped in, mandated participation, and made sure the whole thing was open, standardized, and absolutely free for everyday individuals. So, why did some of these flourish faster or differently than others? Well, it really boils down to regulators forcing interoperability and competition. M-Pesa started off highly privatized, functioning basically like a monopoly early on, and initially lacked interoperability outside its own network. But Pix and UPI, they are heavily anchored by central bank regulation. They demand maximum interoperability. Because the central banks in Brazil and India essentially forced all the big traditional banks to play nicely together, the entire digital ecosystem just exploded overnight. And when I say exploded, I mean exploded. Look at this staggering number, 178 million. That is the number of active users on Brazil's Pix system. It processes over 6 billion transactions a month.
Let that sink in for a second. It moves a volume of value that literally exceeds the entire GDP of Argentina. 178 million active users in just one country. Within months of launching in 2020, Pix didn't just compete with old legacy payments, it obliterated them. It entirely replaced traditional bank transfers and checks, becoming the default rail for everyday transactions. It's now moving roughly 316 billion US dollars every single week.
So how on earth did Pix get a massive 91% penetration among Brazilian adults? Simple. They made peer-to-peer transfers completely free and stupidly easy to use. They used simple aliases. It rapidly rendered legacy billing methods like the traditional Brazilian boleto, which is essentially a clunky printed bank invoice, completely obsolete. You don't need to hunt down someone's crazy long routing or account numbers anymore. You literally just need their phone number, an email, or you just snap a quick QR code. It removes all the friction. Whether you're paying rent, splitting a dinner bill, or buying a snack from a street vendor, Pix is the universal language of commerce in Brazil.
But this isn't just about what's happening inside individual borders. On a macro level, these digital platforms are allowing Africans to completely bypass the US dollar for cross-border trade. Historically, if someone in Ghana wanted to do business with someone in Nigeria, their local currency had to be swapped into US dollars and then converted back into the receiving local currency. Relying on a third-party global currency like that is expensive, it's slow, and it devalues local money. But now, digital banks and mobile money platforms are facilitating direct currency swaps. This is a massive game changer. It's keeping transactions on the continent, reducing friction, and basically helping Africa trade with itself to build a deeply integrated economy.
And the impact here isn't just about faster speeds or crazy transaction volumes. It is fundamentally about changing human lives and building financial resilience. Take a look at this quote, straight from a landmark study published in the journal Science. When people finally have a secure, digital place to store value and a way to instantly receive cash from their extended social network during an emergency, say a sudden medical bill or a failed crop, their overall economic stability just skyrockets. They can actually survive financial shocks that previously would have completely devastated them. And the data uncovers a really striking demographic shift, too. Having access to M-Pesa allowed female-headed households to experience an 18.5% higher consumption growth compared to those without it. Digital money quite literally gave women unprecedented agency. Think about it. By removing the physical barriers and the obvious safety risks of storing physical cash, it allowed women to securely control their own finances, access remittances directly, and ultimately boost their family's living standards way more dramatically than their male counterparts.
Which brings us to this incredible number, 194,000. That is the number of households lifted entirely out of extreme poverty in Kenya. Alongside that, 185,000 women were empowered to move away from subsistence agriculture and start their own businesses. 194,000 households, that's roughly 2% of the entire Kenyan population at the time of the study, lifted out of poverty by simply introducing a more efficient financial tool. Because these women didn't have to waste hours traveling just to safely store or retrieve cash, and because they had a reliable safety net, they could take calculated economic risks. They ditched part-time, low-yield farming, started their own retail ventures, and totally changed their trajectory. Now, I do want to be clear, we absolutely have to acknowledge the nuanced reality on the ground. It's not a perfect tech utopia just yet. For instance, despite 38% of rural Indians actively preferring UPI, there's still profound digital divides and trust deficits hindering universal adoption in remote areas. A comprehensive study looking at rural Uttar Pradesh, India's most populous state, really highlights the roadblocks. While urban centers are practically cashless, rural villages still struggle with spotty internet, a lack of cheap smartphones, and deeply ingrained habits of only trusting physical cash. To really solve this last-mile problem, it's going to require robust offline payment capabilities and massive educational outreach. So, to wrap up our explainer today, I want to leave you with one final, pretty provocative thought. As emerging economies just keep innovating at breakneck speed, is the West fundamentally falling behind in the digital age? We've just seen how treating digital payments as a public utility rather than a private toll road unlocks explosive economic growth, massive financial inclusion, and real poverty reduction. So while the US and Europe are still patching up systems built for a completely bygone era, nations like India, Brazil, and Kenya are actively writing the code for the future. The leapfrogging effect is incredibly real, and honestly, it begs the question, who is really the developing world when it comes to the future of money? Thank you so much for joining me, and keep exploring these incredible shifts.